All right. Okay. So the recording is started. Yeah. Right. So I can say from my side, good evening, but good morning, good afternoon, depending on where you're joining this recording and the time that you're joining this recording. So we are actually building momentum from your task one. I hope you did well, and and well done for all of you. Sorry, to all of you for actually submitting your task one. It is an achievement. I wouldn't want to undermine that. That's quite a major achievement. And plus, I think that we are in a very good position because I would assume that some of you would have joined late due to late registration. That's very much possible. But yeah, so up to task one, sometimes people have to do catch up and all that. But I would fairly assume that the entire class is is in the bus, right? So all of you caught the bus. You are seated now, and there is no one who's playing catch up again. So if I can do this assumption, and safely, I can do this assumption. So that would mean that we're not anymore going to have an excuse of saying I wasn't there or I joined late. So if you all manage actually to put in your submission, your first submission, so we all on the same level. What I would want now is to build momentum. And please, if you can hear this advice, and think it's an appropriate advice at this stage, and like I said, for the purpose of building momentum. So make sure at this stage you keep up with class, you keep up with the lectures, you. So make sure that you are in no way finding yourself on the back foot. So I really would beg you, because I think from this point forward, if you are unfortunately leaving things for the next day, and or you still feel like you have quite a bit of time, I'm afraid you will find yourself in a situation that could cost you the semester. So I trust that that's clear. Obviously, it is. I always give advice, and actually, I had a very good conversation even with the lead academic for I think for the School of Management. A very good conversation. But again, it's I reiterated this advice I give to students, and student would think, you know what, I'm not sure that I'm going to listen to that advice. But what happens is, you see, at the end of the semester, then the student would realize that, you know what, ought to have heed that advice. So I wouldn't want you to be in that situation if you're listening. It's just to say, don't find yourself on the back foot. Don't play the catch up. Just make sure, if you can actually be ahead of the class, go ahead and do that. So I trust that that's clear, right? So a bit of housekeeping here. But yeah, so please make sure that either you are in front of the class or you are with the class, but don't be at the back, right? Don't be late. Don't be leaving things for the last minute, right? So that's the small advice. And we are now going, like we said, we want to be very practical, and we want to be on the money. And now we're moving to Learning Unit 3, right? So the cost of money, right? Hi, Ciara. How are you doing?
Hello, I'm good, thanks. And you?
Sure. I'm doing fantastic. And again, welcome to the party. Please feel at any time, feel free to stop me if you're not understanding any notion. But knowing you, I know that you've already gone through this. And yeah, so guys, stuff money. Is there anything in particular when you were going or either skimming or browsing quickly, is there anything that's really stick out to you, or something that you're not understanding, that, or if you would like to give us maybe even a summary of what you understand by learning Unit 3, please feel welcome. All right. So the moment of silence, I will assume that you're all thinking. But yeah, so I think this picture is a very good illustration, right? So you have the cash, you have the profit, but almost like at the roots, if I can say, the hidden title of this learning unit, it's really much, if you went through the learning unit, you know it's more about the cash, right? So because the learning unit speaks very volume about the cash and how actually we look at cash, right? um so yes, cash can be tracked, right? And if you see, let me just move here. So it says that your income statement can lie about your company's health. I don't know if you would agree with this statement, but I think that that's the thing that you probably, after we went through learning unit 2, you should be certain about that, that there is more than what the eye see, right? So I safely hope that all of you understand that we can't just be looking at an income statement and that's it. So we're just going to um, believe whatever we're seeing there. And so, what we did in Learning Unit 1 and 2, and especially for your task 1, was to show you that there is more than what meets the eye, all right? There's more than that. So, and we need somehow to do a bit of probing, all right? So, yes, profit is an accounting concept, cash is a reality, right? So, when you're looking at working capital, the first thing I want you to have in mind is the current asset. And in a way, we are very much speaking about the current asset because look at it like a working capital, like an engine, right? That would be basically the beating heart of a business, right? It's that whatever is happening in the short term is very, very important, right? But we will need to come back to one of the ratios that we looked at, the current ratio. You see? Remember that difference. So the working capital, it's that difference between the current assets and the current liabilities, right? Is this part clear? Are you clear about this? Or do you have a question on how really is the working capital and the current assets equal in somehow? But if you are clear about this, just give me a thumb up, then I know this part is understood by you. Perfect. Perfect. I'm very satisfied, right? So you have basically, and I'm glad that I put a scale there, but just to show you that there is a balancing act that needs to take place. Whether you are a future entrepreneur or you are someone who is going to be an operator in the hospitality industry, you need to understand this, right? That at the core of any business, you have this short-term cycle, very critical to any business. Without it, a business cannot be profitable, cannot be successful, right? So, in other words, profits can even be in theory, but in practice, we need to look at how we're managing cash, how we're managing the working capital. And I like really this summary that I've just given, right? So it is true that more than half of the time, the financial manager, or in that case, you, who is actually now learning the skills of financial management, right? You will spend much of your time looking at this balancing act, right? Current asset, current liability. Whether you are thinking about a business venture or you are looking at your own company, you need to be able to juggle these concepts, right? So we all know liability is what we owe, and that is very much predictable. But when are we really going to make money? When is the money going to come in? We are talking about our cash inflows, what we will receive. That is not very predictable. Or I would say a better statement would be it could be unpredictable. Obviously, there are different businesses, and some businesses can be quite certain or in a very stable industry, and so the cash inflows are very, very much predictable. But there is that element of saying we know what we owe. You, all of you, so if you have a credit card, look, I'm not assuming that I know really your financial reality, but I'm saying on in everyday life, right? So people have debt, they have credit cards, whether it's your clothing store, you do have a credit card and all that, and you pay that money, you repay basically the money that you owe, right? Because you borrowed money. That is very much every month, whether you have a mortgage, a bond for your house, or a loan for your car, right? You do have obligations, financial obligations, uh, on a monthly basis, if I could say, right? So that's very much something that we know that's predictable. I know at the end of the month I need to pay, but your source of income, you could say, well, my source of income is very much predictable because I'm working, and at the end of the month also I receive. Yes, that's one aspect of cash inflow. But it wouldn't be the same for a business, right? Because a business somehow very much so relies on its customers or its clientele. You see what I'm saying? And your own company, if, for example, it's not getting enough demand for the product that you are offering, yes, it could also go down. All right. So that part, I'm sure that it's quite clear. And there is also another aspect in Learning Unit 3. If you went through it, you could see that we are talking also about the dangers of overtrading, right? It is true that when a business is growing, that's a very good thing, but it could also be pitfall, especially when you are growing aggressively, right? So there is increase in sales that would automatically demand more inventory. And so what companies will do out there, I'm telling you, I'm not necessarily saying how you saw it or how you know it. I'm speaking about the reality of everyday businesses, right? So when companies are growing, there is a growth in their sales or there's a growth in the demand of their product. What they would do is obviously they need to increase their inventory. And so they will take on debts, because remember, it's part of a company to make sure that they show that they are a good business. They are reliable. There's that part of being a good business is that you are reliable. I know if I go to Macro or to Spar and I'm looking for a certain product, I'm sure that I'm fairly confident that it would be there. But if you are going to a company to do business with that company and all of a sudden they don't have what you are looking for, what happens? Automatically you start to view that this company is not really reliable. Maybe I should look for somewhere else. And that's what businesses fear, right? So now that you're taking more inventory on credit, That is an increase in the short-term debts or liabilities, right? Now, the cash from debtors, if that cash, that's how we should put it, if that cash is coming later than the money that you owe your creditors or or your suppliers, that would be a big problem. If you're collecting the money that people owe you after the payment is due for the money that you owe your own suppliers, creditors, and all that, that's a problem. Because I'm receiving the money that I'm supposed to pay these people after. So that is a problem. And we want you to understand that reality. That can be to the detriment of the business. All right. So the business can be on the outlook of it on the outside. It might look like the business is very profitable, is in a very good situation because there seems to be a lot of demand. But the reality is that the business is starving for cash. Is that clear? All right. So I put one of the examples in your textbook. I put it in this format, in the visual format, so that maybe when you are going through it, if the numbers are not making sense, I hope this will make sense, right? Because it is a tale of rapid growth, right? So we are looking at a business that is growing, and they are expanding, and in fact expanding aggressively, and sales is growing over 4 months. You would recognize this because it is one of the examples in your textbook, right? So from March to June, 4 months, you can clearly see there in front of you that it is actually growing. And that's to be a good thing, right? So it's generating more revenue, right? So a 160% increase in monthly profit in just 4 months. By all appearances, this business is doing well, right? But now let's go deeper. Let's see what actually is happening, because profit is growing, right? But the bank account is bleeding. How? So we can see here, look here, you can see at the net profit here. You can see that we are starting well. We do have quite a lot of money, right? And then look at April, a dip, and then May, and then June. Do you see that? Well, look at the revenue. So the bank account is going down, but the revenue is increasing, right? So that's quite interesting. That's telling. So what would be the cause of this? And this question I actually put to you. What is the reason for this?
If your debtors are paying you later than you pay your creditors.
Absolutely, absolutely, Ciara. In fact, I thought that you were going even to add something else there. So yes, we can clearly see that. Yeah, it's the problem that we spoke about. So that's not a good management of the data, right? The data's account. That's not a good management. But that also could be a good example for overtrading. That's overtrading. You are selling, yes, you are selling, but as to when you are collecting that money, is it becomes very unpredictable, and then you can see the consequences for this business. So it is true there is a timing mismatch here, and one of the things that you would not even, so if I ask you this question and you are even sleeping, you have to be able to say, look, I need to look at the data collection period, right? I need to make sure that my data collection period and my credit settlement period align fully. Right? So these terms should now become more familiar to you, right? So the solution is not to stop growing, right? It is, what is the solution? The solution is working capital management, right? So you need to properly manage. So wherever there is a crisis, that's actually the purpose of management. So we need to be able to balance current asset and liability. We ensure that the business is meeting the short-term obligations while at the same time we are maximizing our profits, right? So these four are very important. They are in your textbook, and I've summarized them for you. These four pillars, right, for this credit capital management, right, in quotes, right? So smooth operation. When I mean, what do we mean by smooth operation? We mean that we need to make sure that cash, material, everything that is needed is there. All right. So we have them when they are needed. Because always the first rule is that we must ensure that there is smooth operation. Yes, and that's the reason why, for example, companies will take on debt to make sure that they have the inventory, because it needs to be there. It's one of the pillars. So we're not going to say, well, you know what, now, demand is there, but I'm too afraid of taking on debt or credits. You cannot say that as a business. You see, you cannot say that. So part of management is that we need to make sure that the operation is running smoothly. Right? Operations are running smoothly. We have everything that is needed to do business. Remember, it's the working capital, working capital. And all that engine is in the short term, right? Strategic optimization. So finding the perfect balance between return and risk. These two. So another very important question I would like to ask you is, what is that relationship that you gathered or you understood from your reading between risk and return? That's a very good one. Tammy, you're very quiet, and the killer, you're very quiet. Anything that comes to mind? In fact, there is a particular picture there in your textbook that I would like maybe you to refer to. How do you view the relationship between risk and return? Guys, it doesn't matter if you get it wrong, but just it's what you view. How do you view the relationship between risk and return? When risk increases, what does return do? Does it decrease? Does it go down? Does it go in the opposite direction, or does it go?
So increases.
It also increases. Well done, Ciara. Yeah, I like that. I like that. And in fact, I would like you to just think about this class. Think about the more the risk I take, the more the return should be. Okay? And that would be a very good relationship between risk and return. So the more, obviously, people who are taking more risk, they would expect more return. Less risk. If you see people are taking less risk on something, maybe the return is not that big, isn't it? So I hope that makes it quite clear, right? Cool. So let's look also at another pillar of working capital management. That will be cost minimization. And this actually we did touch on in the past lectures, where we're saying it would be really a good thing to make sure that we are increasing our profit, but we are reducing the cost or the cost or the sorry the the interest in this case. So we are reducing interest and so cost. Actually, interest is the cost capital. It is true, right? So cost of capital is interest. Am I correct or am I wrong? Just give me a thumb up if you think that that's true. How do you define interest? Okay. Again, good point, guys. If you are at this stage, please make sure you're reading Learning Unit 3. Learning Unit 3 is quite quick. So you could be done with Learning Unit 3 in no big amount of time, and then you can move actually to Learning Unit 4. And let me cover then the last. Yes. The interest is the cost of borrowing money. Yes, and that is the cost capital. So that's why we call it cost of capital, right? So yes, and you see a concept like interest. Try to see all the other how can I say appellation of interest, so that you are never thrown away, you are never thrown out when you are writing a test. Maybe they might use another term, and all of a sudden you are like, wait a minute, I don't understand it. So part of you studying and going through this journey of studies is that try to understand all the different ways we refer to interest. So when they say cost of capital, you understand already. You're like, well, what is this thing? This sounds too sophisticated for me. No, they're just talking about the interest, right? So the cost of borrowing money, right? So, and then the last pillar, optimal return. Obviously, we want to minimize cost and we want to optimize the return. We want to minimize the cost. We want to optimize the return. So how can I summarize these four? They're quite easy to understand, right? So we want smooth operation. We want actually to balance risk and return. And we want to minimize the cost while we are maximizing the return. Guys, that's kind of a good summary. So if you are writing down actually your summary, so that guys, you're not going to be studying close to the exam. You will just refer to some of the notes that you've actually made for yourself. Because imagine you are close to the exam, now you're starting to study from learning unit 1. That will be impossible. You're not going to do well. So always have these nice summaries. And that's the reason why I share my notes with you. That's the reason why we have one note, so that it does not take you too long when it comes to preparing for your assessment. All right. So let's move now to this toolkit for transforming paradox into power, right? So we want to master the working capital required. 3 essential instruments, and we will explore one by one, right? So tool 1 is like basically the strategic compass, and that will be your risk and your return. So you look at that, what is the risk in doing this business? Is it worth it, right? What would be the return? And that's why, by the way, there's something embedded in Learning Unit 3. And that's the reason why I'm speaking to you directly. And that's good. Because I want to show you that as you were reading, maybe just reading, you are reading, or sometimes we have the tendency of trying to memorize. Don't memorize anything. Understand what is the core concept that they're trying to teach me here. And how would that apply for my assessment, right? But there's something there in Learning Unit 3 about the schedule. And you guys saw it. So the schedule for the budgeted receipt payment, that will be there in your Task two, it will be there in your exam. It's this part of finance. How do you project future inflows and future outflows? So we give you a scenario. We say month one, you're going to receive this amount. Month two, you are projecting you're going to receive that amount. That's very much finance. That's very much finance. And that's the exercise I want you to be very familiar with. But think about it, ladies. Just think about it. Every time you have to think about a business, what will be the first thing that comes to your mind? It's not just going to be, oh my God, this business is going to be such a beautiful business. You always wonder, how much am I going to make in the first month? How much money am I going to make in the second month? How much money really can I make in a year? Why? Projecting. That's where budgeting is very, 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 very important, right? So whatever you're expecting that will come in the future. And this is practical skills that we are learning, right? So that's how normally you would do. So if I'm speaking to you, Ciara, and I'm saying, Ciara, what is the kind of business you have in mind and all that? Yeah. At the end of the day, besides you just telling me it's a very beautiful business, it's a cool business, right? You will now start thinking, okay, now in terms of cash, money, how much do I think maybe, or how much do I want to get in the first month? Or how much should I be making on a monthly basis? Why am I doing this exercise? To show you that there's always looking toward the future and planning. So the schedule there of what will go out, what will come in, will be always in your assessment. It will always be there. Yeah? So balancing risk and reward will be the first thing. And obviously the second tool, we want to gain cash flow visibility. That's what I've just told you now. Because you always need to think about the cash flow, the future cash flow. Okay? And plan in advance. So how much money will I be paying? Even when you go to a store, you want to get on a new iPhone, you always start with that, how much will I be paying on a monthly basis, right? And then you will say, okay, this is how much I get, I think, I can be able to, you do that exercise in your mind of deducting, right? You do that, right? Am I the only one? So, yeah, that's basically what it's all about. So let me take a pause here at this stage, and obviously don't want it to be a one-man show. So does this make sense? Any questions at this stage? All good. All good. Right. So we can move forward. But as you can see, the last thing will just be we want just to look carefully at that cost. You see, because as you will see, it be quite tricky. But sometimes they might quote you an interest, and that's the part towards the end of your learning unit where you're covering the nominal interest rate and the effective interest rate. But sometimes it could be tricky. Yes, I'm going for the financing of this car. They are quoting me this. How do I know that what they are quoting me is a good interest rate for me? Yeah, or is there other costs that are hidden that I don't know about, right? So yeah, so risk and return, we touched on that. Low risk projects generally tend to have a low return, right? So they could be at times. Remember again, we say it's not one size fits all. It is as it is. You need to be doing a balancing act. It's a skill. It's not Yeah, but yeah. So if you feel like, okay, they're just saying, I just need to deal with the risk. So you are not understanding the learning unit. We are saying we want you to have really the skill of really just looking deeper into each case scenario, right? Because you could have, let's say, a high ratio, 6-1. When we say high ratio, what are we talking about? We are talking about the working capital ratio. We are talking about the current ratio. Okay, current asset divided by current liability. Right. So remember, we said it was very, very good to have enough to pay our debt. Okay. So, for example, you would tell me, Patrick, this is good. 6-1. That means that we have enough assets to cover the debt. So we are safe, right? Yes, we are. We are definitely safe. We are so safe that it's hurting our profitability because we are not taking even any risk. Imagine somebody who's in business doesn't want to take too much risk. But then how are you also going to grow? I hope now it makes sense, huh? You see, so that's the thing. It's not just to say, well, but sir, I read it said, the higher the current ratio is, that's good. And so you are in your exam and you have this question and you write the current ratio is 6-1. That's good. No, so you are missing. You are not fully understanding your financial principles. So, and that's the part where I want you, when you are reading, read really critically to understand. And that's the part where if there's something that does not make sense, bring that forward to say, I don't understand this concept. Yeah. So, but when you're looking now in this case of high risk, high reward, you could have a low ratio. So, with regard to the higher ratio, it could be also that the current asset, if the current asset is too high, what does that mean? Could mean that they are also having a lot of thinkers. They are selling quite a lot of things. Yeah. How beautiful is finance? That you guys, you and I, are looking at the ratio 6-1, but that ratio is telling us something deeper. So 6-1, it means that the current asset is 6 times more than the current liability. Now you ask yourself the question, what is in the current asset? What is in the current asset, guys? Please.
It would be that the company has a lot of trading inventory.
Trading inventory. Cool. So there's inventory. What else is normally in a current asset? So we have the inventory. Yeah, absolutely correct, Ciara. What other element that you find in your current asset?
The debtors.
Debtors. Guys, other ladies, come on, you are there. What other elements do you find in your current assets? So we have the inventory, we have the debtors. What is the other one that you can think of? Pandekile. Come on, do me proud. Short-term investment. That actually will be your inventory. Because you will invest into your inventory and you're going to sell out that inventory. However you're going to use it. But cash, for example, cash on hand, money, cash, money. You see? Very important, right? So always think that way. You are saying, okay, so if I'm looking at 6-1, it's 6 times bigger. Wait a minute. What is in my current asset? That's always how you need to think. All right. So I know I have my inventory. That was the most of it. Absolutely. So now I know I have my cash on hand. I have inventory. What else do I have? I have debtors. Be that we are selling so much on debt, So that's the reason why it's very big. But now look at high risk, high return. It's only 1.2 to 1. 1.2, just slightly. So the current asset is just slightly bigger to cover the current liability. It's not the safest of positions. For some people, they would say, I love the 6 times better because it's bigger, much, much bigger, right? So we can cover it very much. But now what we start to wonder, we are now asked the question, it might look like you are in a risk of insolvency, but it also could indicate high inventory turnover. That you are selling your inventory so fast and paying your debt so quick. And what would that mean? It's more profitable. Do you see how everything is connecting together? So your balance sheet is just not just a bunch of numbers. No. It tells a story, right? So let's move on now to looking at this challenge. While you know exactly when your bills are due, predicting the exact timing of cash receipt from debtors is incredibly difficult. This uncertainty forces businesses to hold more cash than necessary, reducing profitability. And that's the problem. There could be such a big fear, and there needs to be a good amount of fear, but not too much that you are playing it too safe. Because you see, sometimes trading a favorable trade terms can be negotiated when you are paying very well. So yes, they can say, you are a very good customer of us. You always pay your debt. You always pay on time. We're going to give you a 20%. That's all part of working capital management. It's a good thing. But it shouldn't be that you are playing too safe. You don't want even to jump. You don't want even to put your foot in the water for fear of getting wet. So, right? So the solution, a schedule. Like I said again, that's where I said this will be the opening of the big deals that you're going to be doing in finance. Just this. The schedule of budgeted receipts from debtors. This tool systematically forecasts cash inflows by modeling your customers' payment behavior over time. It transforms a vague guess into a data-driven projection. So predictability. So yes, there is risk, but we want it to be a calculated risk. We want to mitigate the risk. We want to deal with the risk. It's not that we are scared of the risk. We deal with the risk. Future entrepreneurs, right? Future economic operator. I hope that that's clear. So we want, and that's the exercise, we want to turn the sales into predictable cash flow, right? So look at this example from your textbook. That's this that I'm showing you here. If you understand this concept, you will be on the safe side. So just take the time to understand this already from learning Unit 3, so that until the end of this course, this is something that has become a skill for you, because you will always be given a scenario where they say, so this is how you expect to collect, right? The credit sale. They say you're going to collect it over 3 months. They're saying after the first month, so the month of sale. So let's say I'm selling something in March. After March, what is after March? April. April, my agreement and my arrangement, or after I've studied the way, because sometimes, customers, they run into problem, they're not able to make the payment. That's why we say you need to study their behavior, right? So for sure that, or you agree with your customer, listen, I want you at least after the first month that you pay me 70% of what you owe me. Okay? And in the second month, you need to pay me 20%. And then in the third month, you pay me 7%. You see that basically you are budgeting. So it's budgeting and it's a schedule. It's a cash collection schedule. So I know, so look very well here. So it's the sale happened in January. How much, what am I going to collect in January? What am I going to collect in February? What am I going to collect in March? Very, very important, very critical, right? Does this make sense? Wow. Silence. Right. Okay. And the kid, you got it. Here, Ciara.
I don't know if I'm just reading this question wrong.
Yes.
But would it not be that March sales was 7%, February sales was 20%, and January sales was 70% on the right hand side of the graph?
On the right hand side.
Wouldn't January be the first month?
Okay, so remember, yeah, no, remember, we are dealing with multiple months, but this is just to give you a picture. So yes, I can understand that you might be somehow, but you can see, for example, so when I'm looking at April and from March sale, so April, I will collect from March sale, I will collect 70% in April. From March sale. But this amount that I'm collecting here, I'm collecting it from February sales. So remember February? So if there was a sales in February, the first month will be March. And after March, April. And that will be the 20% because it's the second month. Guys, I know this might be a little bit confusing. The point was to say, look at the cash, but the best one, you know which one is the best one? It is the actual budget that you have in your textbook, which I'll bring up just right now. Okay? Just give me a chance here. Okay. So before I look at this last one, I think Ciara's question is a good one. So just give me 2 seconds. Let me pull your textbook. Huh? Right. So I hope also in your textbook. So if you go on to page, this is very important, very necessary as usual. Just a second. I don't know where is my magnifier. Almost there. There we go. And I am going to share my screen. Sorry about that, guys, but just bear with me so that we can get the best here. So in your textbooks, I hope you are all there, guys. Remember, we can do a cash budget schedule for our debtors and for our creditors. So, Ciara, the one that I would allude to, because I wouldn't want you to be confused with that one was made just for as a reference for the example. But the one that all of you, the entire class, should always have in mind is this one from your textbook. So I hope that that's clear. So you will always have this. On one side, you have your credit sales. We give you your credit sales. And then on this side, and I want you to be able to build this by yourself. Because you need to be able to say, okay, this is my credit sales, right? So every time you will make actually a sale, there will be a certain percentage that might be cash. Let's say maybe 30%. Maybe 30% is always cash and 70% is on credit, meaning that they need to pay after, right? They take it now, they're going to pay after, right? So you always need to have that. So for January sales, you can see that January, look at January sales here. Do you see the January sales? You can see the budgeted receipts. This is the budgeted receipt in June, budgeted receipt in May. So May, June, July, August, September, October, right? So what they would do, again, when I say always look at the scenario, they would tell you it is from this month to that month. You see, prepare a schedule of the budgeted receipt from datas for the period 1st May to October. Very clear. So from May to October. So don't give me something else. Don't say from January to May. No. Give me what is asked of you. They want it from May to October. You can see page 80 in your textbook, very clear. From May to October, class. You would give me from May to October. You would not give me from January. You will not give me until December. We did not ask you that. We're asking you from May. How much are you going to collect in May? How much are you going to collect in June, July, August, September, October? That's what we're asking you. Either it's a collection or it's a payment. We could ask you actually, look here, prepare a schedule of the budgeted payments to creditors. So we could ask either way, what you are paying out there, what is the schedule? What we just want to know is how much are you going to pay in May? How much are you going to pay in June? Guys, is this clear? Is this giving you a clarity? It's giving you clarity. And you can see January. What is the role of January? What is the role of January? Because if you take a credit sell in January, the next month is February. The other month is March. The other one is April. And the other one is May. So you must look. You can see that they're giving 4 months. 4 months. They're saying 40% will be collected when? In the second month, following the month during which the sales was done. So if it's January, it's going to be in February, 40%. 35% will come when? March, right? So vice versa. So you need to understand this, the schedule. I want all of you to become experts at scheduling the payment. All right? I trust that that's clear. When you're looking at April, the next payment after 2 months, so it's going to be April, May, we skip May, we go to June. But you must read the question because they will tell you after 60 days, it means that you need to skip 1 month. It's quite clear. Oh, this is a good place, really, really, really to stand on, because this budgeting, the reason why you hear me talk about it, and you're like, why is he so up in arm with this budgeting? It is because it's a nightmare sometimes for students. It's crazy. It's like, I'm like, were you even in class? Do you see this beautiful progression? Do you see this beautiful progression? You can see it's going downward, right? So you have months going this side, you have months going that side, and you can see, yeah, you can see, yeah, it's not going all over the place. But sometimes students give me payment here. I'm like, where does this payment coming from? And I'm being serious. I'm being serious. So take this seriously. You can even see. So for a student who has studied, has even seen the progression. You can see that all the numbers are in the middle. They follow a pattern, a schedule. Why? Because we want to make it predictable. So when you have something that is unpredictable, you have numbers all over the place, that should tell you you're not doing the right thing. All right, all right. Sorry about that. But yeah, I just had to, sometimes it can be a nightmare in the exam, you see, especially when you're not doing the right thing. So class, we're about just to finalize the last thing. Remember the last two. I hope you're loving this. I hope you're loving this. The last two will be, like I said, we need to investigate closely rates. Because sometimes a stated rate, a stated rate is not actually the effective rate. We need to understand what is the effective rate. So an effective rate is actually an annual interest rate, compounded annually. Compounded annually. Compounded annually, it means that compounded once a year. That's all. So what we do with all nominal rates that is given to us is we make them in effective term, effective rate. So we need to convert a nominal rate. They can give us a rate that is compounded monthly. They can give us a rate that is compounded weekly. They can give us a rate that is compounded biannually. We need to be able to convert it into an effective annual rate. Does that make sense, guys? So you did cover your compounding with accounting, but should you not understand, you go through um, the journey. So look at our journey for learning unit 3 on ARC. So follow the process, all the steps I've given you, so that at the end of the day, you master this. It becomes something you have mastered, that you cannot be shocked if you have a question, right? So it's not just an accounting function when we talk about capital, working capital management. It is a strategic engine that converts the promise of profitable growth on paper into the reality of sustainable success in the bank. So you need to master it. And growth will always be your ally, never your enemy. Did you enjoy this walk through Learning Unit 3? Thank you so much, Ciara. Oh, I'm sweating, guys, and it's hot here. But I just wanted you to understand it fully. And if you understand it fully, it's going to help you, by the way, to when you're reading this, don't read it just like, it's dull, So it must make sense. And when you are reading and it's not make sense, please stop and start asking questions. Ask questions to your class, ask questions to your lecturer, because it must no sense. Remember again, guys, like we said, the difference between this module and other modules is that you are building a skill. So at the end of the day, especially when you're standing really for your final exam, and there's a reason why it is a written exam on campus, is that we want the proof that you've mastered this skill. All right? So please, I'm going to stop the recording here, but again, encourage you to work, to do your part, to do your homework, and everything should be right. So just before we say goodbye, any questions that you may have?